Hey everybody, this is Paul doing a quick video. It is 7:48. Market is not open. It's the 16th. Sorry about that. Didn't have a chance to make a video yesterday. Um, so I guess let's go over the market real fast before it opens, kind of where everything's at, where the data's at, that kind of stuff. So this is the current portfolio. So as you can see, E-Trade, Schwab, Fidelity right here. As you can obviously see, Fidelity is getting a lot of the attention. Um, So I got this as promised. The majority of the money that I make from here, from there. So currently 1,000, give or take a little. This year alone has been dropped into BBN, um, and kind of as predicted, the market's trading sideways. Um, the data has basically backed up pretty much everything that I said in in January or not in December as to basically what's going on. So let's I guess let's get to some data here. I hope I should have a copy of the CPI. If not, oh, there it is. So here's the CPI. So CPI came in exactly where you would expect it kind of to come in. Shelter is coming down slower than anybody has predicted. Shelter is coming down so slow that the market is completely ignoring the shelter part of this right now, which is kind of weird. So the number is still showing a certain amount, but it's showing I think like 3.9 or something like that, which is still too high above the 2% goal. So the market is still pricing in cuts, but now they're kind of moving them further and further out, and they're making them bigger. So it's kind of weird to explain, but I'll kind of show it here in 2 seconds. So it's basically instead of pricing in a 25 cut in January, a 25 cut in March, they're pricing in a 25 cut in January and a maybe 50 cut in June. So they're just kind of moving things out. So that's how the market hasn't exactly crashed yet. And I imagine the bond market's going to do weird stuff like this up until March when they finally do get in like kind of an answer on what's going on. Um, at some point, this shelter number has to catch up with reality. One would hope, because the if you this is a guy named Charles Biella or Bilello on Twitter. That's his handle right there if you want to see the charts that he posts. But he kind of puts all the numbers together, throws them into a chart, and as you can see, we're in rent deflation. Now, it might not be rent deflation where you're at, but if you actually check that site that I told you all about before, the rent tracker site, so this is just my local market right here, but you can kind of see like, okay, if you live in a two bedroom, this is what you're seeing. But if you live in a one bedroom or a studio, you're seeing this. So that's what they're talking about. So like, so say if you're living, and it's not exactly like, oh, the bad part of town. So like, say Kenner, for example, in my area, studio rent is down 19%, almost 25%. These aren't like ghettos, like this is places where I live. Like, okay, so Slidell for a one bedroom, negative 22%. Covington, really nice area, 10%. Now, if you're in a two bedroom, this is where the problems are. So you can see there's only one area, the rest of them, a lot of them are like, you know, really huge areas that are just kind of seeing rent increases. So that's what they're talking about when they say rent decreases, is you have to look at all of the things that go into rent. And it's not just one type of place. So if you're living in a place that's going up, you can look around and look on this site, which is rent.com, like I said, and you can kind of see the areas around you that are probably cheaper and probably have gone down in price, and it's not some bad area with a lot of crime. That was kind of the one of the issues before, is like, it might be going down, but why would I move there? It's going down for a reason. And the reason why it's going down is just simply this, is so this is single family. So one of the things that was going on is multi-family units were being built big time. Those have started to pull back, but single family is starting to go really high. So that's kind of what's going on. It's just the amount of like places that are coming online for competition is just insane, and that will feed through to the OER. Because OER is a survey where they just basically ask, how do you, how much do you think you can charge versus what reality says. I don't understand. This is what most of the market is why they're just ignoring OER at the moment and focusing mostly on PCE, is because OER doesn't make any sense anymore. Um, so we just have just different things going on. So I think that's kind of where we're going to sit until March. March is going to be the big one. March is going to be where this market either kind of goes back to say 4,600 or it goes above 4,800. And it probably will be before March. Hopefully, there's like a few Federal Reserve members that are like, yeah, we might do a 25 cut in March. And then the market will immediately get new highs. That's just kind of how this works. We're really close to new highs, very close to new highs. And once you get past the new highs, it's the next focus is basically maintaining the cuts, making sure inflation. This is what inflation. Um, so this is kind of what housing looks like right now. Um, just the different shifts in inventory all throughout the country. As you can see, throughout most of the country, there's just a lack of housing, which is weird, but you see for sale signs everywhere. But the problem is it's too expensive to move in, and you can kind of see which states have the worst problems. So these are just different counties that are lit up. Um, and then we have this is basically the market expectations for Fed funds rate. So this is why the market is doing what it's doing. This chart right here, and this is another one that Charles Biello put out, but you can kind of see this is what the market is literally pricing in. Now, if you listen to the Federal Reserve members, they're not talking about any of this, really. They kind of expect maybe something similar, but like not on this path. Or some Fed members expect it to be 5.33% or whatever up until 2025, and they're crazy. That would take out the entire economy. So, and then here's just different debt. So this is really the kind of the time bomb and kind of in the background here is that one of the bigger reasons that we need to cut, or they need to cut eventually, is either they're going to bail out CRE as it continues to roll over at higher interest rates, or they're going to cut because there's just too much debt on too many balance sheets for too long that's worthless right now that nobody will buy. Would you buy a bond yielding 2% or would you buy a money market fund yielding 5%? So that's kind of the problem that we have right now is that nobody wants any of the current debt that exists. It's just a big issue. Um, One of the bigger issues also is that services unemployment, ISM services. This is a red flag. This is just a flat out red flag. Um, this is effectively measuring temporary unemployment or temporary jobs. And as soon as, employers were done with temporary jobs, barely any of those jobs became permanent jobs. So those are those jobs where they say they're going to hire you for like say 3 months or something like that, or they're going to hire you for a month and then try you out. And a lot of those people that got hired for say Christmas is like temporary jobs. Now this could be by choice, but this many at this rate is just red flag central. Every time that this goes down to this level right here, we're already in a recession. So there's people that are ignoring this. There's a lot of people that are ignoring this, and then it's just a technical thing or whatever. I wouldn't ignore that. If this shows up negative next month, I think this market and the Federal Reserve take it very seriously. And then also here's your inflation map to kind of show you where inflation is kind of whatever, just going down. All right, like where inflation is currently. And the biggest contributors to inflation, obviously, is the outlying areas right here. So the South, obviously, it's having massive growth as just this massive wave of people move from up here to down here. Um, Louisiana's kind of feeling that too, just different areas. So this is just kind of, you can pause right here to kind of look at that. And this is where this data is pulled from. This was like a Bloomberg chart that somebody posted on Twitter. And yeah, I think I'm just going to continue the current plan of just dropping money in the BBN as it comes in. I see no reason not to. As the market continues to price out rate cuts, this is going to go down. And all it takes is one or two Fed members that actually have voting power to come out and say, yeah, things are kind of starting to slow down. But the big dates that you're looking for is probably around February 15th and beyond. And then that's where you're going to start to see if maybe some of the services data is coming start slower. But that's kind of what we're looking for right now. Um, no reason to have this be a very long video, since, like I said, there's not much to talk about. The only thing that the market has to watch is CPI data. Everything else is just noise, unless we go to war with Iran. That's a problem. But everything else is just noise. The only thing that matters is the CPI data that comes in and the employment data. That's the only two numbers you got to watch. Everything else is just people just talking, don't know what they're talking about because they can't predict the future. So I think that's where we're at right now. So, let me know what you think. Have a nice day.